Okay, guys, so today I wanted to talk about how we can use interest rates to pick the best Forex market to trade and always be trading inside of a trending market. Okay, so what are interest rates? Interest rates are essentially the reward we get for saving a currency. So investors will look to invest in a currency that has high interest rates. So we can do this and we can pair a high interest rate currency and a low interest rate currency, and we're going to get a very good trending market. So, take for example USD and JPY. So, USD has a 5% interest rate. This is for example, okay, and JPY has 0.5% interest rate. This means that the reward for saving dollars is quite high. You're going to get 5% return. So, you're going to be a lot of investors are going to be buying dollars and selling yen, as yen has a very low reward for saving, and this means USD JPY is going to increase. So if we look at the chart, as we can see, since COVID, the Fed have been hiking rates, which means increasing rates. So as they've been increasing rates, USD JPY has been increasing, and JPY, the yen currency, has sort of stayed about the same. It's sort of stayed about 0%, so it's not really incentivized. There's no incentive for investors to stay in that currency, pretty much. And this is a good example of when you pair a high interest rate currency and a low interest rate currency. Now, if we had two currencies that had very similar interest rates, or we'd sort of be stuck in a consolidated market, or if we had two, let's say, two high interest rate currencies, the market wouldn't trend as well as we'd like. Okay. Now, the next thing I want to talk about, what I think a lot of traders miss, is expectation and how that influences the market. So even though, let's take example USD JPY again here, even though here, at this point here, where my cursor is, interest rates are still very high for the US dollar, and they still remain quite high actually. And so, and also yen interest rates are down, well, still down about 0.5%. But what's changed is the expectation. What's changed is the Fed are beginning to cut rates. Okay, the big Fed have started to cut rates by 0.5% or whatever, and yen has started increasing rates by about 0.5%. So even though there's still a massive difference in the interest rates, USD JPY start to fall, and that's because traders are pricing in their expectations of what they think the central banks are going to do in the future. So if they're expecting the Fed to cut the rates and the Central Bank of Japan to increase the rates, they're going to be looking to sell USD JPY. And I think that's really important, because I think a lot of traders miss expectation is really important in financial markets, and it plays a big role. Okay, it's not just about what you see on paper right now, it's about what traders are expecting to happen and what they think is going to happen. It's all about predicting stuff. That's how the whole financial market moves. It's all about math psychology and what people are pricing in and what they're expecting to happen. Okay, I think that was really a really important thing I wanted to touch on in this video. I think that's a lot of things a lot of traders miss. So, yeah, thanks a lot, guys, for watching, and goodbye.